KKR, Kohlberg, Kravis, and Roberts, you know the firm, one of the biggest in private equity, is teaming up with a mutual fund titan, Fidelity Investments, to sell shares of its private equity companies as the firms prepare for an increase in initial public offerings. According to these companies, Fidelity will exclusively distribute KKR stock in its own offerings to investors. That's a key point. The move comes after a slump in IPOs made it harder for private equity firms such as KKR to sell their investments. The exit strategy, so to speak. Joining us now with more on this story is Bloomberg's own Jason Kelly. Jason, always great to have you here. This is a really, really interesting development. KKR, right. We know it wants to get into capital markets.
Right.
But in order to do so, it's going from high, top of the market to the bottom of the market, effectively Fidelity, mutual fund firm. How does this all work?
Well, the way it works, and Eric, as you know, what KKR has been doing, they've been more aggressive in this area than any other private equity firm and really diversifying beyond just the business of buying companies, fixing them, and selling them. What the capital markets business allows them to do is get a piece of that selling process. It allows them to make some of their own money and at the same time not pay money to big Wall Street banks to sell those to sell that stock.
But that's one key point to be made here. It's KKR's own portfolio companies that they're taking public as opposed to other private equity firms, right?
That's right. That's right. This business is really focused on raising money, either debt or equity, for their own companies, the companies they own, which is not an insubstantial number. 50 companies, billions and billions of dollars in annual revenue, hundreds of thousands of employees.
Now, KKR has financial wherewithal of its own, obviously famous for being run by Henry Kravis and his cousin, George Roberts. But why team up with Fidelity?
Well, it puts them into an area that they are not able or unwilling to build out, essentially. This allows them to distribute these shares to retail investors. They don't have the capability to do that. They can underwrite offerings and sell them to big institutional investors, but the business of selling to retail investors, that's a business they're just not in and they don't want to be in.
Okay, so we get why KKR is doing this. It doesn't have to give up fees, 7% we should add for IPOs,
That's
right? To the likes of Morgan Stanley, big competitor in this arena, Bank of America, Merrill Lynch, another one.
Right.
What does Fidelity get out of it, though?
Well, what Fidelity gets is another product to sell to their own clients. I mean, this is presumably an enticing offer to get a guaranteed or get a better into a deal that has been run by one of the most premier private equity firms in the world. You know, RJR Nabisco, they own maybe not the best deal in history, but it's a name that's known. KKR is a name that's well known. And they own the likes of Dollar General, TXU, the former TXU Energy Future Holding Companies. This is a way for, smaller investors to get a piece of that.
Okay, with about 30 seconds left, what does it tell us about the IPO market? Is it thawing?
Well, it's hard to go that far at this point. I mean, these guys are certainly teeing themselves up for the time when it does come back. I mean, when I talk to the firms about this deal, they provided some cautious optimism that maybe in the not too distant future, maybe not this year, but certainly into 2010, there could be some opportunities here.
Well, with fees like 7%, they're hoping that turnaround in the IPO market comes sooner than later.
Absolutely.
Jason Kelly, always great to see you. Thanks for being here.